Your government does not need to raise taxes to take your money. It can do it quietly, legally, without telling you. It has already done it, multiple times, in countries that look exactly like yours. In 1945, Britain showed exactly how. And they never called it a tax. The war had been won, but the bill had just arrived. Winning the war left Britain nearly bankrupt. Debt at 250% of GDP. The government could not tax its way out. Default was impossible, so it did something else entirely. No legislation was passed. No minister explained the plan. No announcement was made. What happened instead, a coordinated arrangement between the Bank of England and commercial banks kept interest rates below inflation for nearly 3 decades. Every creditor received every pound they were owed. Every payment arrived on schedule. By 1980, the real value of that debt had fallen by approximately 80%. No crisis, no headlines, just silent loss. And almost nobody noticed it happening. The creditors lost most of their purchasing power, without a tax, without a default, without a single honest explanation of what was happening to their money. That is mechanism 1. There are 4 more, and at least one of them is operating in your country right now, and if you think this is just history, you are already late. Here's what no one tells you about how governments actually collect from you, without ever sending you a bill. But before we go further, you need to understand one rule. All 5 mechanisms share the same design. A tax is visible. It is legislated. It appears on a pay stub or a receipt or return. The citizen knows it is happening. The politician who imposes it must defend it. The mechanism can be challenged, reduced, or reversed through the democratic process. The 5 mechanisms examined in this video share a different characteristic. They extract wealth through systems that are either invisible to the people affected, classified as something other than taxation, or so technically complex that the transfer is complete before most citizens understand it has occurred. This is not a conspiracy. It is just how the system works. Governments facing fiscal pressure have consistently found that visible taxation generates political resistance. Invisible extraction does not. The incentive to prefer invisible mechanisms is not malicious. It is rational. And the historical record documents the preference consistently across countries, political systems, and centuries. The 5 mechanisms are financial repression, civil asset forfeiture, bail-in legislation, pension obligation transfer, and regulatory wealth extraction. Each has a documented history. Each is currently operational in at least one major developed economy. None of them require your consent or your awareness to function. The first mechanism is financial repression. Economists gave this a name in the 1970s, financial repression. The definition is precise: keeping interest rates on government debt artificially below the rate of inflation through regulatory requirements, capital controls, and coordination between central banks and commercial lenders. Here is how it actually works. When inflation runs at 4% and the interest rate on government bonds is 2%, the real yield is negative 2%. Every year, the holder of that bond loses 2% of purchasing power. Over 10 years, they lose approximately 18% of the real value of their holding. Over 20 years, more than a third. You do not lose your money all at once. You lose it slowly enough that you do not react. For governments carrying large debt loads, this negative real interest rate is not a problem. It is a solution. Every year of negative real rates reduces the real burden of the debt. The nominal debt remains unchanged. The real value of what is owed declines quietly and continuously. The British experience of 1945 to 1980 is the most extensively documented case, but it is not unique. Carmen Reinhardt and Emispelin Sprancia, in a 2011 paper published by the National Bureau of Economic Research, documented financial repression across multiple developed economies in the post-war period. They calculated that liquidation of debt through negative real rates amounted to transfers averaging between 2 and 3% of GDP per year in the affected countries, comparable to the magnitude of outright taxation, accomplished without any legislative act specifically authorizing the transfer. The United States engaged in similar policies during the same period. Federal Reserve Regulation Q capped deposit interest rates. Banking regulations required institutions to hold government securities. The combination kept rates below inflation for extended periods. The mechanism did not disappear after 1980. It reappeared in a different form following the 2008 financial crisis. Central banks in the United States, United Kingdom, European Union, and Japan held interest rates near zero, and in some cases negative, while inflation gradually increased. From 2010 to 2022, the real yield on most developed economy government bonds was negative for extended periods. Savers who held deposits or bonds in this environment experienced the same transfer that British creditors experienced after the war: quieter, slower, and without announcement. The people who paid this cost were savers, people with fixed deposits, pension funds obligated to hold fixed income, retirees dependent on bond yields for income. The transfer was from creditors to debtors, from savers to borrowers And the largest debtor in every developed economy is the government itself. No tax was levied, no receipt was issued. The transfer occurred silently through the yield on instruments that most people consider safe. The safest place for your money is often where it loses value the fastest. If your money is sitting in a bank right now, this is already happening to you. Not maybe. Not in the future. Already. You worked for that money, you saved it, and the system is slowly draining it without asking you. The negative real yield does not wait for your permission. It operates through the system you are already inside. Here is the part most people miss. The second mechanism is civil asset forfeiture. It operates through a legal doctrine that exists in a form unique to the United States, though variants exist in other jurisdictions. The doctrine holds that property itself can be charged with a crime, independent of the owner's guilt or innocence. The government does not need to convict you, or in many cases even charge you, to permanently seize property it asserts was connected to criminal activity. And this is where it gets real. Between 2000 and 2019, federal agencies alone seized approximately $68 billion in assets through civil forfeiture. State-level seizures add considerably to this figure. The Institute for Justice, a legal advocacy organization that has studied this issue extensively, has documented cases in which individuals have had cash, vehicles, and property seized without charge, and have faced legal processes in which the burden of proving their property is innocence fell on them rather than on the government. The mechanism contains a structural incentive that compounds the problem. In most jurisdictions, the law enforcement agencies that conduct forfeitures retain a percentage of the proceeds. This creates a financial incentive for seizure that operates independently of the stated law enforcement purpose. Agencies that seize more property receive more funding. The incentive structure does not require corrupt intent. It simply aligns institutional interests with the act of seizure. The people most affected by civil forfeiture are not wealthy. They typically cannot afford the legal costs required to challenge a seizure, costs that often exceed the value of the seized property. The mechanism, by design, applies most effectively to people for whom the cost of resistance is too high to justify. You do not have to be suspected of a crime for this to happen to you. You only need to be carrying cash in a jurisdiction where the law allows it. In 2014, the Washington Post published an investigation documenting that civil forfeiture had generated more revenue for law enforcement than burglary had generated for criminals in the same year. The comparison is instructive, not because it is precise, but because it establishes the order of magnitude of the transfer. This is not taxation. It is classified as law enforcement. The property owner receives no receipt, no credit, no offset against any future tax liability. The transfer is complete when the seizure occurs. The legal process for recovery, where it exists, is designed in a way that makes successful challenge difficult for most people in the position of having property seized. This is where it gets dangerous. The third mechanism is bail-in legislation. The term entered public consciousness following the Cyprus banking crisis of 2013, when depositors at the two largest Cypriot banks had portions of their savings. Above 100,000 euros converted to bank equity by government order. This was not a tax. It was not classified as a government seizure. It was legally defined as a restructuring of the bank's liability obligations. The depositor became a shareholder. The shares they received were worth a fraction of the deposits that had been converted. The mechanism transferred wealth from depositors to the restructured bank, and implicitly to the government and European institutions that had required the restructuring as a condition of broader bailout support. What many depositors in other countries do not know is that legislation enabling similar mechanisms has been enacted in multiple jurisdictions since 2013. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in the United States in 2010, includes provisions for orderly liquidation authority that allow regulators to impose losses on creditors, including depositors, above the insured threshold, in the event of a systemically important financial institution is failure. The Financial Stability Board, an international body coordinating financial regulation across major economies, has issued guidelines encouraging member jurisdictions to adopt bail-in frameworks as an alternative to taxpayer-funded bailouts. The United Kingdom's Banking Act 2009, as amended, includes bail-in provisions. The European Union's Bank Recovery and Resolution Directive, adopted in 2014, established bail-in as the standard framework for bank resolution across EU member states. These frameworks were presented as solutions to the moral hazard of taxpayer bailouts. They are that. They are also mechanisms that, in a sufficiently severe banking crisis, transfer losses to depositors rather than to taxpayers generally. A transfer that falls most heavily on people with deposits above the insured threshold, which in most jurisdictions is not a high bar for businesses, pension funds, and individuals with accumulated savings. The Cyprus case proved that the mechanism works as designed. The question it leaves open is not whether the mechanism exists. It does, in legislation across multiple major economies, but under what conditions it will next be activated. If you have deposits above the insured threshold in any developed economy, this legislation applies to your money. It is not theoretical. It is enacted. Imagine checking your bank account one morning, and part of it is just gone. Not stolen, not hacked, legally taken. This is legal. That is the point. Almost nobody notices this one happening, and this is the one nobody talks about. The fourth mechanism is pension obligation transfer. This operates differently from the pension system failure examined in a previous video. That video examined how governments underfund their own pension obligations until the gap becomes a crisis. This mechanism examines how governments shift private sector pension obligations onto workers and retirees through regulatory and legislative changes that are classified not as taxation, but as pension reform. The clearest documented case is the United Kingdom's treatment of defined benefit pension schemes from the 1980s onward. In 1988, the Thatcher government changed the incentives for private sector pension provision in ways that made defined benefit schemes less attractive for employers to maintain. In 1997, the Brown Treasury removed the ability of pension funds to reclaim dividend tax credits, a change that reduced the annual income of British pension funds by approximately £5 billion per year. Pension funds that had assumed a certain level of dividend income when calculating their obligations were now structurally underfunded by the removal of income they had incorporated into their projections. This was not presented as a tax on pension savings. It was a change to the dividend tax credit rules. The effect on pension funds was a consequence, not the stated purpose. But the effect was real. Billions of pounds of income that had been funding pension obligations were redirected to the government as revenue. In the United States, the shift from defined benefit pensions to defined contribution plans over the past 4 decades has transferred investment risk from employers to workers. This transfer was facilitated and encouraged through the tax code, through the structure of 401k plans and IRA accounts. It is not taxation. It is not classified as extraction. But the actuarial consequence is a transfer of risk from institutions capable of bearing it to individuals who are less capable of managing it, and the outcomes in retirement are structurally worse for most workers than the defined benefit system they replaced. The result, workers now carry retirement risk that their employers used to carry. That transfer has a real cost. It was never put on a tax return. If you have a 401k, a defined contribution pension, or any retirement account where investment performance determines your outcome, you are bearing risk that was transferred to you through a regulatory process you were never asked to approve. This is the one that is hardest to see and the most expensive. The fifth mechanism is regulatory wealth extraction. This is the most diffuse and the most difficult to quantify, but its existence and scale are documented in academic and policy literature with increasing precision. Governments regulate. Every regulation imposes compliance costs, and those costs flow in one direction. Those costs are borne by regulated entities, businesses, and ultimately, the consumers and workers those businesses serve. When regulatory costs are disproportionate to their stated purpose, or when they primarily benefit well-established incumbents at the expense of competitors and consumers, they constitute a form of wealth extraction that operates through the regulatory framework rather than through the tax code. The documented examples span multiple sectors. Banking capital requirements, imposed through Basel III and subsequent frameworks, require banks to hold more capital against their loan portfolios. This reduces the availability of credit and increases its cost. The benefit, greater financial stability, is real. The cost, reduced access to capital and higher borrowing costs for households and businesses, is also real. The cost falls most heavily on borrowers who cannot access bond markets directly, small businesses, households, and individuals without access to sophisticated financial instruments. Environmental, social, and governance requirements imposed on institutional investors have, in multiple documented cases, redirected investment flows in ways that reduced returns for pension beneficiaries whose funds were required to adopt these frameworks. The requirement is regulatory, not legislative in the direct tax sense. The cost to beneficiaries is real. Occupational licensing requirements in the United States, which now cover a wider range of occupations than at any previous point in the country's history, restrict entry into labor markets and raise prices for consumers while transferring income to licensed incumbents. A 2015 report commissioned by the Obama administration estimated that occupational licensing costs the average American household approximately $1,000 per year in higher prices for licensed services. These are not taxes. They do not appear on any return. They are extracted through the price of haircuts, the cost of borrowing, the returns on pension funds, and the wages of workers who cannot enter licensed professions. The mechanism operates through the regulatory infrastructure of the state rather than through its taxing authority. The transfer is real. Its classification is not. The 5 mechanisms share a structural characteristic that the historical record makes consistent across all of them. They are most effective when they are least visible. Financial repression works because the negative real yield is not labeled as a transfer. Civil forfeiture works because the legal process for challenge is designed to be difficult. Bail-in works because most depositors do not read bank resolution legislation. Pension obligation transfer works because the connection between regulatory changes and retirement outcomes is indirect and delayed. Regulatory extraction works because the cost is embedded in prices and returns rather than presented as a line item. Visibility is the enemy of these mechanisms. When financial repression is named and documented, as Reinhardt and Sprancia did in their 2011 paper, its scale becomes legible and its political status becomes contested. When civil forfeiture is documented, as the Institute for Justice and investigative journalists have done, reform legislation follows in some jurisdictions. When bail-in is understood by depositors, the political conditions for its use become more constrained. This is not an argument that all of these mechanisms are equally unjust. Some of them, particularly the regulatory frameworks, serve genuine purposes alongside their extractive effects. Financial repression, as a mechanism for reducing unsustainable debt loads, may in some circumstances be preferable to the alternatives. Civil asset forfeiture, whatever its abuses, was designed to address genuine problems in criminal enforcement. The argument is narrower and more specific. These mechanisms extract wealth from private individuals and redirect it to governments or their preferred interests. They do so without the visibility, the democratic accountability, or the electoral consequences of direct taxation. And they operate most effectively on people who do not know they exist. The British saver, who held government bonds in 1955, lost purchasing power steadily for 25 years. She received every payment she was promised. She did not lose anything that was named as a loss. She simply watched, year by year, as the purchasing power of her carefully accumulated capital declined in ways that were connected, through a mechanism she was never asked to understand, to the government's need to reduce the real value of debts that were too large to repay any other way. She is not unusual in the historical record. She is the pattern. And the pattern, across every documented case of government fiscal distress in the modern era, shows the same 5 mechanisms being deployed in various combinations, never announced as taxation, never presented as extraction, always described in the language of financial stability, law enforcement, pension reform, or regulatory prudence. Most people will watch this and forget it. The ones who do not are the ones who stay ahead. Look at your country. Be honest. Of the 5 mechanisms examined, financial repression, civil asset forfeiture, bail-in legislation, pension obligation transfer, and regulatory extraction, which one is already operating where you live? Write it in the comments. Be specific if you can, because once you see it, you cannot go back to not seeing it. And the moment you can name what is happening to your money is the moment it stops being invisible. I read every comment. The answers shape what this channel examines next. The British debt-to-GDP ratio of 250% in 1945 reached 60% by 1980. No default was declared. No extraordinary tax was levied. The contracts were honored. The purchasing power was not. That is not coincidence. That is the mechanism. And the mechanism, once understood, is visible everywhere the historical record documents fiscal distress, which is to say, in almost every developed economy currently operating. The question is not whether these mechanisms exist. They are documented, legislated, and operational. The question is whether you can see them. The scale of these mechanisms, when aggregated, is not marginal. The Congressional Budget Office has estimated that civil asset forfeiture in the United States generates several $billion annually in government revenue. The academic literature on financial repression documents transfers averaging 2 to 3% of GDP per year during the post-war period. The pension obligation transfers in the United Kingdom and United States, if measured by the actuarial value of risk transferred from institutions to individuals, run into the trillions of dollars over the relevant decades. Regulatory extraction, the most difficult to quantify, has been estimated by the National Association of Manufacturers and other business organizations at hundreds of billions of dollars annually in compliance costs alone, excluding the dynamic effects on competition and prices. None of these figures appear in any tax table. None of them generate a receipt or a credit. None of them are reported on any return that any individual files with any government. They are the fiscal infrastructure that operates beneath the surface of the visible tax system. And in aggregate, for many people in many circumstances, they extract more than the visible system does. This is not a recent development. The historical record on financial repression alone spans centuries. Governments have debased currencies since antiquity. Roman emperors reduced the silver content of the denarius. Medieval kings clipped coins. Early modern governments issued paper currency unbacked by the reserves they claimed to hold. Each of these was a transfer from holders of the currency to the issuing authority. Each was accomplished without a tax. Modern mechanisms are more sophisticated. They operate through central bank mandates, banking regulation, legal doctrine, and accounting standards. They require specialists to understand and lawyers to contest. They are, by design, accessible to challenge, primarily by those with the resources to mount a challenge, which means they fall most heavily on those without such resources. The British saver of 1955, the American whose cash was seized at a traffic stop, the Cypriot depositor in 2013, the British worker whose pension fund lost £5 billion in annual dividend income, the small business owner whose borrowing costs increased because of capital requirements designed for systemically important financial institutions. Each of them experienced a real transfer of wealth. None of them received a tax bill. That is the design. And the design has been consistent across governments of every political stripe in every developed economy for as long as governments have faced the gap between what they spend and what they can visibly collect. Understanding the mechanism does not make the transfer stop, but it does change the terms on which you engage with the systems that execute it. The question the British saver of 1955 never asked was, if my bond is paying 2% and prices are rising at 4%, where is the difference going? The answer was always the same. It was going to the government, through a mechanism that had no name on any statement she ever received. It has a name now, several names. And the mechanisms are documented, legislated, and operating in the economies of every country whose citizens are watching this video. The question is not whether you are affected. The historical record does not support the position that anyone holding savings in a developed economy is unaffected by these mechanisms. The question is whether you understand which ones are currently active, and what the historical record suggests about what comes next when governments find themselves in the fiscal position that most developed economies currently occupy. That is exactly what this channel breaks down.